Yeah.
Where are you? Where are you? Where are you? Where's YouTube? We all frozen or am I crazy?
Yeah, it's
We look a
really
little
bad on
frozen
the.
to
Folks?
me. I can hear you, but I just see a frozen image. Okay. Can you guys hear me okay?
What are we doing, folks? I hear you now.
K-
Everybody was
Biggs,
frozen.
can you
I'm
hear
still
me or
frozen.
no? Okay.
There's going to
Maybe
be
not.
Yeah.
there's going to be leads and lags on conversations. I'll say something and 5 minutes later, Burner will hear it.
Ending the year strong, you know?
Yeah.
All right. Everything's shared. Let's go.
Okay. Well, we'll give it a go.
Boogie chilling.
We'll give it a go. Um, well, welcome to Wall Street Beats. We may be a little technologically challenged today. We're going to get through it. Today is Tuesday, December 30th. It's our last show for the year. So I'm going to put a bow on 2025 today with my friends Charlie Peabody and Kevin Baker and Berna Barche. And I'm going to start out with Charlie. What's on your mind today, Charlie?
Well, there are two things I want to talk:
Uh-oh.
Citigroup and talk silver. So let me start with Citigroup because last night after the close, they announced the sale of their Russian banking operations. This is something that we all knew was in the works, and it was just a question of when. Um, I want to point out while they acknowledge that they'll take a $1.1 billion loss in the fourth quarter upon this sale, and the sale probably won't close it's sometime in the first half of next year. My guess is in the first quarter. Um, the $1.1 billion loss is related to a foreign currency translation adjustment. And so while it will look bad on the reported P&L, it will have no impact on regulatory capital because that foreign currency translation adjustment is already reflected in the regulatory capital. The end result is that when this thing is sold, it will actually be a net benefit to the regulatory capital. So you have two transactions now that are going to close in the fourth quarter that will benefit Citigroup's capital position. The first is the Fernando Chico Pardo acquisition of 25% of Banamex, and then the second is this Russian bank sale. Both of those, as I said, are net benefits to the capital position at Citigroup. So I expect Citigroup to continue to buy back stock at a very rapid pace. A couple of things that I think they're going to announce in January when they report earnings. The first is I think they're going, so they have about a little less than 6 billion left under their old $20 billion buyback plan, and they've been buying back stock somewhere around 5 to 5.5 billion a quarter. So that $6 billion, is not enough. So they're going to have to announce another share buyback program. As I said last time around, they announced a $20 billion share buyback program. I think they're going to up that anywhere from 25 to 40 billion going forward. Now that's a multi-year, not a 1 year, but a multi-year buyback program of 25 to 40 billion because of the capital that's being freed up through these various transactions. So they're going to end up, depending on what happens to Citi's price, buying back anywhere between 4 and 6% of their stock in 2026. So the robustness of their capital position continues to be very strong. They come into this year with over 9 billion of excess capital, before they've done anything such as these transactions or generate earnings organically. So they're in a really good capital position. And the stock is trading at 1.2 times tangible book. It's additive or accretive to tangible book as long as you're buying back stock at anywhere below 1.5 to 1.7 times tangible book. So I think they're going to be very aggressive in the short run. So that's
Um,
the capital situation that's very strong. The other thing I wanted to mention on,
Let
um,
me ask you just a question on Citi. I mean, you've been talking about the stock all year. I'm going to commend you
right.
on an incredible pick because, the stock was in the 70s in the beginning of the year and it's around 117 now. Which, if you're talking about a tech company, okay, fine. You see those kinds of moves all the time. But for a bank, it's pretty unusual to see this kind of move on a bank, especially a large cap bank. So, great pick there. How do you feel about them buying stock, up, north of 110 when it's had such a move this year? As you said, like it's still cheap on a price to tangible book level, but it's certainly probably not as cheap as it was going into the year. Are you comfortable with stock buybacks at these levels?
I am. Now, obviously, I do believe it'll be accretive up to at least 1.5 times tangible book, maybe even up to 1.75 times tangible book. A lot depends on how well and how rapidly they improve their returns. I don't think they're going to do this in January, but they do have a May investor day next year. And I think, they're going to up their expected returns from the 10 to 11% that they projected for 2026. So the return on tangible common equity, at 10 to 11% is not a very robust target. So I think next May they will increase that target, to the, let's say, 13 to 15% range over the medium term. And I think they can get there given the excess capital that they have and the momentum that they have on earnings. And that's the second thing I want to talk about is the momentum that they're going to have on their organic earnings growth going into 2026. So last 2 or 3 weeks, they had two, we'll call them consent orders, but two um, regulatory issues that were resolved in their favor. And so their flexibility improves going forward because they're not working under these regulatory edicts. One related to their trading operations, the other related to their risk and management controls. And the bottom line is they have they have spent about $3.5 billion a year on what we call transformation expenses, dealing with all of these regulatory issues. They say they're about two-thirds of the way through, getting to the targets of where they need to be to satisfy the regulators. And these recent removals of restrictions or consent orders is an example that they are making progress. So that the $3.5 billion of spending is probably going to start to turn down in 2026. On top of that, they have 960 million of estimated severance charges this year. That will turn down next year. And then they have another billion two of stranded costs related to the exits of these banks, like the one in Russia, and their consumer banks around the world. Bend down the expense structure. So, in other words, expenses will go down in absolute dollars in 26 versus 25, and again in 27 versus 26. So you get any kind of revenue momentum, you're going to have very strong positive operating leverage, which also will help, with improving your returns. So I continue to be very constructive on Citigroup. I have no problem with them buying back their stock up to 1.5 times tangible book to 1.75 times tangible book. And I'll leave it to Bakes as to what he thinks the upside is. But I know in the past he's talked about 140. So Bakes, do you have any thoughts about the Citigroup chart?
Yeah, well, I posted this in the member chat the other day because this caught my eye. This is January of '08 back here, and this is when the news. This is probably around when Bear was going down, right around that time. This month, back in '08, the stock opened at 222, closed at 185, but hit this low of 140. And I'm a big believer of the longer these levels exist, the more pronounced they become. When Charlie was in the 40s, I don't know, back here or so, this is a Louise Yamada base, Brobdingnagian. This 82 level from this is the October November '08 level that was a lid for 17 years. And when you break above a lid, a resistance level after 17 years, that shows you've got a lot of pent up buying demand coming. And I don't think this is going to be it over here. 17 years versus 1 year. I just don't think that's the way it works. I could be wrong, but I think 140 is a very reasonable place for it to digest its gains. And I try to go down to Connecticut, every so often and tackle Charlie and unplug his computer so he doesn't tell too soon. I'm usually, horrible at that, but so be it. That's my lot in life.
I'm gonna yell at Bakes because he's just been so unsuccessful. I mean, I sell way too, I buy too early and I sell too early, and I've begged Bakes to keep me in these stocks when they run like this. I've stayed in City, thanks to Bakes,
And
so I
out of
appreciate it.
curiosity, is there a way to gauge? I think the most logical thing in the planet is everybody has been genuflecting to J.P. Morgan for most of the last 17 years, and if you want to outperform, I think you have to own Citi versus J.P. Morgan, or at least you did. Do you have any sense as to institutional ownership of J.P. Morgan coming down and Citi gathering what they spill?
Yeah, there's no question. I mean, City's been one of those stories for decades that has failed to execute, and that's what's different under Jane Fraser. She is finally holding her senior management to be accountable, and she is executing on her promises. Right now, the hurdle rates are pretty low. I mean, generating a 10, 11% ROTC is not anything to brag about. Um, but she is executing, and so that's the positive. In terms of J.P. Morgan, they have benefited from passive investing because they are so they're a big part of the
Yep.
S&P and the Dow Jones indices. So if we get this, I'll call it the dispersion trade, where you're moving out of the weighted S&P into the unweighted S&P, the RSP. I think that hurts J.P. Morgan. So I've written that they may be a victim of their own success. And they're generating a 23% ROTCE right now, and it's likely that ROTCE is going to go down towards 17% in the next year or two, whereas Citi's at a 10 or 11, and it's likely to go up towards 15%. So I like the thought there, Bakes, that maybe you see money coming out of J.P. Morgan into Citi. There's no
Yeah.
question that J.P. Morgan, the franchise and a management team, is viewed as light years ahead of Citi. There's no question about that. But that's reflected in the valuation. And when you look at J.P. Morgan, their earnings per share this year will grow maybe 4%. Half of that's coming from share buybacks. Next year, maybe it grows, in that 5, 6, 7% range. Again, half of that's coming from buybacks. They're buying back stock at 3 times tangible book. That's capital destructive. And Jamie Dimon has mentioned several times that he hates buying back his stock at those levels, but he doesn't know what to do with the excess capital. So, I do think Citi is the better incremental investment, even though I have tremendous respect for the franchise that JP Morgan has built and is investing in.
Do we see any sign
Well,
of that dispersion trade coming back?
I think we do. I mean, I'll defer to you, Bernie. You are more general than I am, but I'm involved in a lot of different trades. I mean, the precious metals, the industrial metals has been a home run for me this year. But even healthcare, we've seen money going into healthcare. I think it's still going into energy, although they haven't moved as much. Um, and personally, I'm looking at the deep cyclicals. I mean, if Trump is going to succeed, he's going to run this economy hot, and we could have a 3% GDP next year. I mean, there are things that have to happen first, so I'm not betting on this in a big way, but I'm certainly doing the research on the deep cyclicals. And the three areas that I'm looking at are packaging companies, chemical companies, and staffing companies. And I've nibbled at some of them. They're all flat on their back, as you can imagine. A deep cyclical is not the most attractive name, but energy also fits into that theme. But if you listen to the banks, they're telling you that they're starting to see corporations gain more confidence. In other words, the issues around tariffs have been resolved. The issues around trade are gaining visibility. The issue around taxes have been are now known. But the only thing that they say is still has a fog around it is this whole immigration policy and the impact it has on labor. But if we can gain some greater insight into that, some of these staffing companies, take a look at them. If you want to look at a long base, and depressed bases, take a look at Manpower. Take a look at Robert Half, RHI and MAN. We've got 7.6 million job openings, and we have any kind of run hot economy success, there's going to be a hiring effort going on. So I like some of these things. I honestly have not done a big position in any of them, but I'm nibbling, from time to time. And then actually, if you look at the National Federation
Yeah,
of Independent Businesses,
I just wonder.
if you look at the National Federation of Independent Businesses, you'll see their number one expectation in 2026 is to hire. And that's where most of the hiring occurs, the NFIB type institutions. So,
Right.
sorry,
I mean,
Connie, go ahead.
I'm thinking more the broadening of the economy is different from a broadening of the market, right? Like I'm just looking, and I haven't seen sort of the stats of like how much of the concentration has of performance has been concentrated this year in the top names. I mean, we certainly have a lot of dispersion within the Mag 7 this year versus some of the recent years, with Google up 66% and Amazon only up 6%. We've got a lot of dispersion, but we still have had huge gains this year in stocks like Google, Nvidia, Eli Lilly, like I still see a lot of crowding in those names. So just curious,
Well, listen,
we've seen broad
silver.
economies not translate into broad stock performance. So I'm just, I sort of the indexing thing has been going on for so long, and the combination of concentration, passive investing, and also just concentration into these sort of, anointed names. I think we were all sort of waiting for a broader market. I was just curious if there was, you think that the economy could lead us there.
I do. And listen, silver and platinum way outperformed any of the Mag 7s, way outperformed. And then if you look at the international markets way outperform the U.S. markets. I mean, the S&P was up
Sure, but I
17%.
mean,
Many of
but
these
those are
international
relatively
markets are
small
up,
pieces of the
particularly
market. There's
emerging
always
markets
something
are up,
that
30, 50%. Look at Africa. Look Africa, AFK, it's up 71% this year. So I do
Mhm.
think money is starting to flow out of the Mag 7 into other sectors, and particularly international sectors, emerging markets. Um, so yeah, I'm a big believer that that trade continues and that the Mag 7 continues to lag.
Got it. Um, let's see. So let's move on. Did you want to? Did you have something else today, Charlie, or should we move on to bakes?
Yeah, yeah. So I'm going to start off with some fundamental commentary on the silver market, at least in terms of what I'm hearing, and then hand it over to Bakes to see what he's seen in the charts. But as anybody who's followed the precious metals knows, silver's had a phenomenal run, and it's gone from gold to silver ratio has gone from 100 to 50, probably headed to 25 over time. The silver is probably still a long term, bull market. But short term, I think you saw some activity over the weekend that says maybe a short term top is in place, or we have to do some consolidation. I mean, the so let me tell you what happened over the weekend, and then we can go from there. And I'll leave it up to Bake to interpret the charts. But there was there indications that over the weekend, a major bank started to liquidate their silver short position due to some margin calls. Um, it's it's very difficult to know if that story is true or not, but there's there is enough evidence around it to know that it's probably some truth to it. Um, Also, during that same period, we saw repo financings. They were 17 billion on Friday. They were 39 billion on over the weekend, Monday morning. So there was definitely that's huge repo financing. I mean, we haven't seen that since COVID days. So we know that there was some stress, and then if you look at the overnight repo financing rates, they were above the upper end of the Fed funds target, which again is a sign of stress. What's difficult about interpreting that is it related to what was going on in the precious metal markets, or is it related to year end normal liquidity stresses? So, it's a confusing time of the year, so you can't make any definitive statements, but there's reason to believe that there's been some stress around the silver markets and other precious metal markets based on the price action, the amount of repo financing, and the rates that are being required to borrow. So if you look at Sunday night's action, I think silver hit as high as $83 and then traded down to around 72 or lower. And I believe it was a major bank liquidating its position, its short squeeze due to a short squeeze. So let's talk about. So there are two names that sort of were rumored, and I want to stress rumor because I don't know anything. HSBC was involved apparently, and JP Morgan was involved apparently. And this is all rumor, so I don't want to give any more credence to those names as being involved. I know nothing about HSBC because I don't follow it, so I'm going to leave that one alone. But let me talk about JP Morgan, um, because here there is some plausibility on what I know that would add credence to the fact that maybe they were involved. So let me tell you what I know. So every bank that I follow takes risk. That's the business they're in, is risk taking. You can take operational risk, you can take credit risk, you can take interest rate risk, you can take market risk. Each bank has a tendency to take more risk in one area versus the other, three, for example. So, like for example, Bank of America will take more interest rate risk than other banks because that they believe they're good managers of interest rate risk. In the case of JP Morgan, their history is that they've always taken more market risk than other banks. And so that lends credence that they could have been involved in this silver debacle over the weekend because they do take more. You remember a couple, or maybe it was more than a decade ago, they got involved in the London whale trade and got caught there and lost billions of dollars. So their tendencies to take market risk also supports the fact that they could have been involved in this. The second thing is if you go to their 2025 10K, page 17 of the written copy or page 68 of the electronic copy, they have some disclaimers about the risks that they're taking. These are boilerplate disclaimers, but they do give you an indication of where the vulnerabilities are for an institution. So let me read what JP Morgan says. An adverse change in market conditions in particular segments of the economy, such as a sudden and severe increase in commodity prices, could negatively negatively affect revenue. So that's very different than what they say about energy. They talk about a sudden and severe decline in energy being negative for revenues. Here they're talking about a sudden and severe increase in commodity prices as being negative for revenue. So it gives you an indication of how they're positioned. It has been well known, so that's point number two. Point number three, it's been well known that JP Morgan has always had a short in the silver markets. Um, and I'm not going to discuss the numbers out there because I think a lot of them are very misleading, but they do have shorts in the silvers market. It's also well known that they have had to fire traders in the past for spoofing the precious metals market on the downside. Um, so, you know, some of these things do suggest that, you know, JP Morgan could be involved in the silver trade that is blowing. Let me give you some numbers. So the commodity trading revenues for JP Morgan run about 7 to 10% of their total trading revenues. So it's not going to break the bank if they have a problem there. But you know, it is not something that's small either. So you know, again, this is something you know you want to watch when they report earnings in January. They had earlier in December, I think it was around the 5th or 7th of December, they gave a forecast for what they expected their fourth quarter trading revenues to be when they report them in January. I believe they report on January 13th. Yeah, Tuesday, January 13th. They said they expect their markets revenues, total revenues for the fourth quarter to be up in the low teens percentage year over year. So if they come in, let's say mid single digits or high single digits, it probably is because they took a hit in the precious metals market from being short. Um, the final thing I would just mention, you know, you can see this in their 10K and 10Q filings. When you look at their commodities trading activities, it's a lot of what we call level two securities. And level two are, you know, you're not trading in the actual security, you're trading in derivatives. And level two is defined as you don't have any direct price measurements. You have measurements that are based on observable prices of other securities. So it does suggest that the type of trading and derivatives actions that they have in the precious metals are slightly more volatile and less liquid. Um, and then finally, they are also known as being very big in the structured note market related to commodity contracts. So all of those things do suggest to me that there's some plausibility without any knowledge. There's some plausibility that they could have been caught up in this precious metals squeeze on silver. So I'll stop it there. Do you want to make any comments on Bakes? I
And
mean,
Charlie,
I think
the other
silver
thing
put
that
in
I,
a top.
yeah, I'll go through. Well, first of all, the CME also hiked margin requirements, which you know sure as hell didn't help. And that's what happens when you know these things go up. They get phone calls and people increase the margin requirements. But I think some perspective is in order. And I'll just go through this. And I've talked about this on the show, you know, several times. I bought this is SIL. This is the Global X Silver Miners, mainly you know more junior miners, not the Coeur d'Alene's and Heclas. This is the buy June 3. I'm not going to draw the arrows because I don't have the patience, nor do you. Um, and on that's June 3rd. Here's 1020. When it became 10% plus of the portfolio, I peeled it back. So let's say it was 12, 13, and I pulled it back to 10. And by dumb luck, I you know avoided you know some of this, and here I am right now. But you know, when you go up 90%, you have to put up with days when you go down five. And I just think it's ridiculous. You know, oh my God, the peak might be in, but I don't see it here yet. So you know, I'll watch this very closely. I'll watch these gaps. I'll see how it acts when it touches this support back here. This is 80. This is the ETF, not silver itself, but it's the same kind of thing. You know, so I let my winners run. This is up 79% down from 90. I'm not going to be crying, and it's around 9% of the portfolio right now. And yes, I am always looking for better ideas as I go through my 5,000 plus ETFs, which I'm doing on Thursday in the midst of football, which is probably two of my favorite things on God's earth. So we'll see what happens. But right now, the trend is up. This is a correction, a high volume correction. So I'm paying attention, and I've taken some off the table, and I might have to take off more. And if I find a more attractive idea, this goes out and that goes in. But right now, I'm still a bull in silver until proven otherwise. I'm going to talk about platinum unless anybody's got something to say. Platinum had its
Nope.
margin
I got
requirements
nothing to
taken up
add on
as well.
silver.
Sorry? Platinum, May 23rd is the buy, somewhere around here. Okay. And two sells. When it hit 10%, I peeled some off. Is that right? Yeah, I peeled some off at 10%. And then when I doubled my money on Christmas Eve, I sold half. So now it's about 5.7% of the portfolio. I'm not up 103%. I'm only up 85%. And we'll see how this consolidates. If this is a staircase being built, or it's an escalator down to the support at 35.40. But so this is for me right now. Platinum, Granite Shares Platinum (PLTM), which just owns the metal. This is not a miner. This is a representation of owning the metal in vault somewhere. This is I've got 5.7%, and it's pure profit. And so it helps with days like yesterday when it's down 12%. I say that's okay. I'm playing with the house's money. It is pure profit, and just psychologically, it helps me hold on and let the winners run even further. So I'm still a bull here. I'm less of a bull. I'm not going to kid you, but until I see some technical deterioration beyond what I saw today and yesterday, then I'm going to stay with platinum. I got one more, then we'll get Burner and her sore throat out of here. Okay, fair. This is me going through the charts like I always do, and I have not pulled the trigger on this, but I just printed out the fact sheet. This is the iShares MSCI South Korea. Samsung and Hynix are the two biggest names, make up the bulk of this. So it might be a quasi South Korea Nasdaq, but this is looking really, really good to me. And I'll let you know if I decide to pull the trigger. I'm not early. I understand that, but this could become my 10th name. I've got 9 right now. I'm 25% in cash after all the sales that I've done in silver and platinum. So that also helps yesterday, where I don't feel like quite the idiot for waiting for top tick. I've got some cash to offer flexibility. That's what I've got.
Got it. Well, I think that's a good place to end it for the year. I think looking that'll be South Korea sounds like an interesting idea potentially for 2026. Looking forward to hearing what you find when you go through those 5,000 charts while watching football on Thursday. So you'll keep us posted on that.
I'm getting misty-eyed
I
just
will be
thinking
seeing
about
a
it.
bunch of I've got a bunch of meetings coming up in January, hopefully some fresh ideas for 26 then. So with that, I'm going to wish everybody a happy new year. I think we're back next week, bright-eyed and bushy-tailed, ready to get at 2026. So everyone have a safe and festive New Year's, and we'll see you next year.
Thank you all.
Thanks, Dave.
Thanks, Jen. Happy New Year.
Thanks, Jen.
Bye.